Welcome to today's Daily Brief Explainer. We've got a really fascinating top-down analysis lined up for you today, looking at how massive global events are directly impacting the financial markets. We are going to connect the dots across the entire global economy. We'll kick things off by looking at geopolitical friction and oil supply dynamics in the Middle East, and then trace those shockwaves all the way down to domestic economic health, tech sector dominance, and finally, high beta assets like cryptocurrencies. It's a brilliant chain of cause and effect, and the data we're looking at today is absolutely eye-opening.
Here's the roadmap for today. We're covering geopolitics and oil markets, the aftermath in the Strait of Hormuz, the U.S. economy and equities, tech sector dominance, and finally, that massive Bitcoin breakout. Let's get right into it.
All right, starting off with Section 1, Geopolitics and Oil Markets. So, the big question driving a ton of geopolitical risk right now is this. Exactly how long can the Iranian regime withstand the intense global economic pressure they're facing? It's really a test of endurance, right? And the answer? Well, it all comes down to the math behind their exports. Take a look at this number, 250,000. That's the estimated number of barrels of oil they are pumping out and exporting every single day. Now, because oil prices have been trending up, that relatively capped volume is actually generating some serious capital. It's giving them the US dollars they desperately need to keep control at home, pay their bills, prevent social unrest, and make those politically sensitive transactions like buying missiles from China. Basically, the higher the price of oil, the better off they are, which is exactly why keeping regional tensions high and prices elevated is right in their playbook.
Moving right along to Section 2, the Strait of Hormuz, Aftermath.
You know, it's pretty ironic, but attempting to restrict the Strait of Hormuz has actually turned into a massive strategic misstep. The real winners here, the US, Russia, and Canada. The US specifically is coming out way ahead, with a much stronger dollar and surging oil revenues. But on the flip side, the losers, the ones really taking the hit from these disrupted supply chains, are Europe, Asia, and Africa. Plus, this whole situation just shines a giant spotlight on how vulnerable the strait really is, which is only speeding up the global rush to find alternative routes and stripping away its strategic leverage. So, what does this actually mean for global oil supply? There's this rumor going around that the markets are about to be absolutely flooded with cheap oil. But if we actually look at the hard supply data, yeah, that's highly unlikely. Sure, OPEC increased their production limits, but actual physical output is still totally constrained. And while the UAE might pump a bit more outside of OPEC limits, they're going to be super careful not to crash the market. What about the US? Well, they are exporting more, but they're draining their strategic petroleum reserve to do it. Eventually, they have to buy all that oil back. Long story short, do not hold your breath for a massive flood of cheap oil.
Because that massive flood just isn't happening, we're likely looking at prices stabilizing right in that $70 to $80 per barrel range. This is a super interesting sweet spot. It's elevated enough to rake in serious cash for the exporting nations, but it's chopping around below major resistance levels, meaning it's not quite high enough to completely wreck the broader global economy.
Shifting gears to Section 3, the US economy and equities. Now, despite all that geopolitical friction and those oil constraints we just talked about, the U.S. economy is proving to be incredibly tough. Look at the latest estimates from the Atlanta Fed. They're projecting second quarter U.S. economic growth to blow past 3%. This is a huge data point, right? Because it totally crushes the narrative that global supply bottlenecks are dragging the U.S. straight into a recession. Make no mistake, that underlying economic engine is still humming along.
And honestly, when you look at market sentiment, things get even more fascinating. Right now, we are sitting at about 65% bullish versus 35% bearish. Now, you might be thinking a bump in bearish sentiment is a bad thing, but mechanically speaking, it's actually really constructive. Bearish sentiment has ticked up just a bit recently, which tells us the market hasn't hit that extreme top-of-the-market euphoria just yet. Because we aren't maxed out on confidence, the S&P 500 and the NASDAQ literally still have legitimate room to run higher.
Which brings us to Section 4, Tech Sector Dominance.
You really have to appreciate the sheer magnitude of what tech is doing right now. When we calculate the ratio between the XLK, that's the major technology ETF, and the SPY, representing the broader S&P 500, we are seeing relative strength approaching levels we literally haven't seen since the year 2000. This is not just some flash in the pan. This is historic, extreme, relative strength. Tech is absolutely in the driver's seat of this market. And leading that charge, the Magnificent Seven, the ETF tracking these absolute mega-cap tech giants, ticker symbol MAGS, is testing some major historic resistance levels as we speak.
If we get a breakout above those all-time highs, man, that could act like rocket fuel, significantly accelerating the broader market's upward momentum before we even sniff a sharp correction.
And finally, Section 5, the Bitcoin breakout and targets.
Okay, for the longest time, the whole narrative was all about the crypto winter, right? People were clinging to this rigid 4-year Bitcoin cycle, assuming we'd see a crash. But the actual data? It tells a completely different story. The 4-year cycle is basically a myth. What's really happening is that Bitcoin's price action is incredibly tied to broader industrial activity. Recently, those industrial activity indicators finally crossed that crucial 50 mark into expansion territory, and almost like clockwork, Bitcoin started to rip. The economic sun has officially melted the crypto winter.
So where do we go from here? Well, here's the exact step-by-step technical roadmap based on the current setup. Step 1, Bitcoin has to prove this breakout is real by holding strong support right around that $79,500 level. If that floor holds, Step 2 is challenging and breaking through the resistance at $85,000. And if it can successfully clear that 85K hurdle, that kicks the door wide open for methodical, step-by-step climb toward the massive $100,000 to $125,000 range. We're talking about a gradual progression here, not just an overnight moonshot.
Which brings us to our final thought for today. We've got incredibly resilient U.S. growth and oil prices that are constrained but totally stable, but we also have tech valuations brushing right up against dot-com era highs and straight-up euphoria flooding back into Bitcoin. So I want to leave you with this to chew on. Do these historic levels of strength and momentum signal the dawn of a massive, sustained, long-term bull run? Or are we looking at the ultimate precursor to a sharp, inevitable market correction? It is the multi-trillion-dollar question, and the data over the coming weeks is going to be absolutely critical to watch. Thank you so much for hanging out with me on today's Daily Brief Explainer. Keep your eyes on the charts, stay focused on the data, and I'll catch you next time.